It's E&J Capital, Providence, Rhode Island. Hold on. Today we're talking about expected move of a stock. Today we're in Providence. Check it out. PPAC. If you want to go see the Blue Man Group, they're coming through. So listen. All right, there's two different ways you could check the expected move. When we say expected move, we mean the reason why you would want the expected move of a stock would be so you could have an estimate at which a stock will move after a binary event. A binary event is something that could affect the stock, such as an earnings, FDA approval, some sort of announcement, bring volatility to the stock, which either goes up or down, and this is the formula you use to best guess at how much of a move this will be. There's two different formulas you could use. This textbook version, this is the one I read when I was reading finance book. So this is the formula. SP stock price times implied volatility times the square root of number of days until expiration and number of trading days in the year. So let's break it down simple. Stock price, you go on any app and you figure out what the stock price is at the time. IV is implied volatility. Implied volatility is how much of a range a stock can go after this event. If something has high implied volatility, that means a stock is riskier and has more of a chance to go high up or down low. Keep it wrong. Something like Roku or Tesla tends to have high IV, Coca-Cola or Bank of America, which has low IV. And number of days until expiration, talking about number of days until the contract expires in an options contract. Like, let's say when you're looking at the option chain, there's different dates at which you could buy an option contract. We're going to use an example. Let's say Apple has earnings in 2 weeks. And what you do is you look at the Friday and you choose that implied volatility that is shown on the option chain. So let's say 18 days. So let's say Apple right now is trading at 257.06, and you multiply the IV, and we're going to use 18 days away, and the implied volatility of 18 days away was 18.45%. What the hell? Come on, man. Leave that in. Alright, look. And like we said, 18 days away until it expires. So 18. And if you didn't know, there's 252 trading days in a year. That's your first step. Next step is you want to turn the percentage into decimal form. And you, simple enough, 1845 in decimal form. Now, 18 divided by 252 is 0.0714. So, like, this is a square root. Use a calculator. What you do is you get that number, press the square root button, and then you'll get the answer, which is 0.2672. Now do it out. 257.06 times 184 times that.
Missing the 5.
Where's the 5? You scumbag. Well, that part didn't really matter. But 257.6 stock price times IV, 0.1845 times 0.2672. Off the top of my head, that's 1267. So that would be 1267, and that's in dollar form. That means in 18 days, Apple will either be plus or minus 1267. On the high end, it will be 263. On the low end, it might be 244. Listen, at the end of the day, all that don't really matter. Trump could say something slick, wipe out all your portfolio. So, listen. Alright, so, quick breakdown. Stock price times implied volatility times the square root of number of days until expiration, number of trading days. After you've done your math, you get 1267. That's a dollar amount. Plus or minus $12.67. If you ain't good at math, ask my math teacher. I was a straight B student. That's about it. We're going to do a new video sometime next year. Been out.